All right, markets are at all-time highs after a benign CPI report. The question is, can the good times continue, and is there more good news on the horizon to spur more gains? Joining me now is Landsberg Bennett Private Wealth Management CIO, Michael Landsberg. All right, Michael, is there another catalyst waiting in the wings for the market? I feel like we've run through all the good news that could possibly happen at this point. Surely there's something else.
Well, it has been a lot of good news, Jerry, but I think part of the positioning has been institutional Wall Street's been really wrong this last quarter. I mean, going into the quarter, they expected earnings to grow at 2%. They're north of 11. So what's happened is they're playing catch up. You'll see a lot of the institutions are short the S&P, they're short Russell 2000, and that's really helping this market get more legs higher. I think ultimately we get some clarity around tariffs and around deregulation, it'll be another leg higher.
I think it's so funny that individual investors, people like you and me, people like the people who watch this show, have more patience with their investments than do the people who do it for a living. There's a real tug of war out there between institutional and retail investors, with retail taking more risks. Are they taking risks that are too excessive?
I don't necessarily think so. I think when we look at the two of them, I think the institutional community has been way too conservative. They underestimated where earnings were going to be badly. It wasn't they missed it by a little, they missed it by a lot. And again, having lots of shorts on when the average investor, for example, has been more aggressive. Now, I would argue maybe too much concentration, too much, some of these, everyday options that expire every day. Yeah, those are probably a little bit more aggressive and from a beta standpoint than probably you should be. But I think when I look at the two of them, they're so far apart. Maybe there's some room in the middle where the institutional community has to kind of pick up the slack because they're lagging. A lot of them are lagging individual investors because they've been so negative.
I love that so much. I can't tell you. To see the little guys beating Wall Street, that's so awesome. Let's talk about risks that might be emerging, because invariably there are some. What's on your list, and how can I position myself now to lower that risk profile?
I think, Jerry, what we see with a lot of folks that come in kind of off the street is they don't have enough diversification. Obviously, if you've owned the AI trade for a while, that's great, but you probably want to expand that. I think, one of your earlier guests talked about adding more diversification even within that sector. We think that's important. But also international. Most investors are grossly underweight international. International's outperformed the S&P 500 this year. Makes sense to add that. You're not giving up performance, but you're lowering risk. But also utilities, industrials, and some financials have done really well this year, and it's a non-AI trade. You can't have everything in your portfolio in the same theme, because when it doesn't go right, like March and April, You have these huge drawdowns. So diversification is important.
I like that idea. Okay, specific stocks. Give me some names here.
Interactive Brokers is a name we really like. It's a benefactor of all this trading. Huge margins, 70% margins in the business, and they're expanding out their overseas operations. We think they're nimble, very well-run organization, and it probably continues as volatility continues, trading continues. They're going to be really in a good spot. That's one of the names. We also like Philip Morris. I'm not going to tell you that the Zin is a healthy
I was going to say, I'm kind of surprised at this one. What do you like? What does Philip Morris do that you like?
Zin, because I'm going to tell you it's not healthy, but it's a lot healthier than regular nicotine and cigarettes. And what's interesting is it costs a lot less to manufacture it. And if you remember the swearing in of RFK, he had some Zin with him. So the regulatory environment's not bad. It's more profitable, better margins, and we think people are still going to look for nicotine, just maybe not the bad old-fashioned way of the cancer sticks.
All right, Michael, appreciate your help today. Thank you so much.
My pleasure, Jerry. Good to see you.